Renting an empty room to someone for $150 a month sounds like free money. You build 4 steel walls, put up a fence, and collect the check. But what most people miss before they put 5 or 10 million into one of these properties is how fast the math turns on you. One competitor opens up 2 miles away, and suddenly your easy cash cow is barely covering its own mortgage. To understand why this happens, you have to look at what it actually takes to get into this game today. If you want to build a modern, climate-controlled facility from scratch, forget about starting cheap. You're looking at $6 to $10 million before a single tenant ever clicks a padlock shut. First, you need land. You can't just buy a cheap plot out in the middle of nowhere. You need high-visibility acreage right along a busy suburban commuter corridor. That parcel alone will easily strip $2 to $3 million out of your pocket. Then comes the dirt work, and this is where first-time builders get hit with massive cost overruns. Before you pour an inch of concrete, you're dropping another $1 million on mass grading, stormwater retention basins, high-voltage electrical hookups, perimeter security fencing, and heavy asphalt paving that won't crack when a 20-ton delivery truck drives over it. Then you build the actual structure. Heavy structural steel, multi-story concrete slab floors, and hundreds of modular steel walls run anywhere from $70 to $100 a square foot. For a standard 70,000 square foot building, that's $5 or $6 million in raw framing and unit fit-outs alone. Add in city impact fees, architectural plans, civil engineering, and massive commercial HVAC systems to keep the air moving, and you've committed millions in bank debt before you make a single dime. Buying an existing facility is usually cheaper up front, but that comes with its own set of problems. In this business, there is a massive gap between what people call Class A institutional assets and older, lower-tier properties. A prime Class A facility is a multi-story building with climate control, high-end security cameras, keyless smartphone access, and a location right next to high-income housing developments. Those trade for massive sums, sometimes $20 or $30 million, because the rental income is reliable. Then there are the older drive-up metal buildings with gravel lots 2 or 3 tiers down. Independent buyers often pick these up thinking they landed an easy bargain, only to discover that repaving 50,000 square feet of cracked asphalt and replacing hundreds of rusted, water-leaking roll-up doors costs more than the building itself. So here's the first thing nobody tells you when they picture owning self-storage. Most people who own top-tier storage facilities today don't even own them individually. They own them through real estate investment trusts, REITs for short, like Public Storage, Extra Space, or CubeSmart. A storage REIT is a massive corporation that owns thousands of facilities across the country, using massive scale to squeeze every bit of profit out of every square foot. Ordinary investors can buy shares in a REIT on the stock market for $50 without ever having to fix a security gate or deal with a broken lock. That is a completely different world than an independent owner putting their life savings into one single building in one town. Now, say you buy a property and the purchase price seems fair. Before you collect a single rent check, there's a layer of hidden costs that catches almost every new operator off guard. First, there are variable property tax assessments. City and county tax assessors track commercial sales very closely. The moment you close on a facility for $8 million, the local government reevaluates the property based on that new sale price. Your annual tax bill can double or triple within 24 months, instantly eating up your profit margin. Second, there are deferred maintenance issues on specialized equipment. Security keypads short out, automated gates break, and rooftop cooling units wear out. In a climate-controlled building, a single roof leak isn't just a minor mess, it ruins a customer's expensive furniture, leading to high-value insurance disputes. Third, there's the operational transition. If the previous owner kept rents artificially low just to show a 95% full building on paper, raising those rates to real market value will instantly trigger a wave of move-outs that can crater your income during your first year. This brings us to how a storage facility actually makes its money, because it's more layered than just renting rooms. The first layer, of course, is base unit rent. A basic 10 by 10 non-climate unit might go for $120 a month, while a climate-controlled room of the same size gets $150. In a typical 50,000 square foot building, you fit around 400 total units. The second layer is tenant insurance and protection plans. This is pure, high-margin profit hiding in plain sight. Almost every modern operator requires tenants to carry insurance on their belongings. The facility sells a simple $2,000 coverage policy for $15 a month. The actual insurance company takes maybe $3 or $4 of that, and the facility keeps the remaining $11 as an administrative fee. Multiply that across 400 units, and you're adding tens of thousands of dollars of pure profit straight to your bottom line without adding any physical overhead. The third layer comes from administrative fees, lock sales, packing supplies, bubble wrap, and truck rentals parked out front. For a well-run facility, these secondary income streams can cover a major chunk of the monthly payroll. There's also a counterintuitive detail hiding inside unit pricing that most outsiders miss. Smaller units make far more money per square foot than large ones. A massive 10 by 20 unit might rent for $220 a month, which comes out to $110 per square foot. But if you take that exact same space and split it into 4 small 5 by 5 locker units, you can charge $60 a month for each one. That brings in $240 from the exact same footprint, raising your yield to $1.20 per square foot. Unit density is worth more than open floor space. A row of tiny 5 by 5 lockers near the front office can actually be the most valuable real estate in the entire building. So far, storage sounds like a great business. But now, look at the other side of the ledger. While day-to-day physical maintenance is low compared to an apartment building, the fixed debt and overhead expenses are unforgiving. Commercial loans on these properties are rarely fixed for 30 years. They adjust or balloon every 5 to 7 years. If you financed a $6 million build-out at a 3.5% interest rate, and you suddenly have to refinance that loan at 7% or 8%, your monthly debt payment explodes overnight. Add to that property taxes, commercial liability insurance, software licensing, digital marketing ad spend, and utilities for climate control. Running heavy air conditioning units. Keep a massive concrete building cool through the summer can run thousands of dollars a month before you pay a single dollar toward the principal on your bank loan. And here's the trap almost nobody sees coming. Even a mostly full facility can lose money. If the local market gets flooded, it's not just about how many units have locks on them. It's about what it cost you to get those tenants in the door and how much they actually pay. A facility might look 90% occupied, but if half those units were filled using extreme promotional discounts, like first month for $1, and you're locked in a price war with 2 other nearby locations, your actual cash flow can be dangerously weak. High physical occupancy does not mean high financial profit. To make matters worse, corporate REITs don't use simple price lists anymore. They use algorithmic pricing models similar to airlines and hotels. When a facility's 10 by 10 units drop below a certain occupancy threshold, their system automatically drops the online rate to $49 to undercut every independent owner in the area and lure customers in. The customer spends an entire weekend loading a moving truck, hauling heavy furniture, and packing their life into that box. 6 months later, once the tenant is completely settled, the algorithm kicks in and quietly raises their monthly rent to $110. And almost nobody moves out. The sheer physical effort and friction of renting another truck and moving heavy boxes means most people just swallow the price hike. An independent owner using static, fixed pricing simply cannot compete with that setup. This highlights the core structural vulnerability of the entire industry. Self-storage is an absolute hyper-local commodity. Over 80% of your customers live or work within a tight 10-minute drive of your front gate. If you own an apartment complex or an office building, your pool of potential tenants comes from the entire city. In self-storage, your market is strictly your immediate neighborhood. If you build a great facility and project that it will take 2 years to fill up your units, you are completely at the mercy of what happened on the empty lots around you. If a developer buys a plot 2 miles away and puts up an 80,000 square foot facility, your local market goes from balanced to completely oversupplied overnight. Because storage units are fundamentally identical metal boxes, local customers will jump to the cheaper option down the street. To keep your building from emptying out, you're forced to cut rents. But while your rental income drops by 30%, your bank mortgage, property taxes, and insurance bills don't go down a single penny. And what happens when a tenant simply stops paying rent? Pop culture makes people think you can just cut the lock off, hold an auction on Tuesday, and make your money back. In reality, state storage lien laws force you through a legal nightmare. You have to send certified legal letters, wait anywhere from 30 to 90 days, publish public notices in local newspapers, and strictly follow statutory timelines. Make one tiny clerical mistake before cutting that lock, and that tenant can sue you for wrongful sale of their property. And when the auction finally happens, most abandoned units fetch a couple $100, nowhere near enough to cover months of unpaid rent and legal fees. So, does owning a self-storage facility actually work as a business? The honest answer depends entirely on your location, your local competition, and your debt structure. In the good scenario, you own a facility in a growing suburb with strict zoning laws that prevent new competitors from building nearby you. You run dynamic pricing, keep financial occupancy high, mandate tenant insurance, and maximize your small unit mix. In that case, low labor costs and steady rental checks produce reliable cash flow month after month. In the bad scenario, a competitor opens a massive facility 3 minutes down the road while you're still trying to fill your units, setting off a local price war. Your rental income drops right as your bank loan interest rate adjusts upward. Utility bills, taxes, and insurance keep rising regardless of your unit rates, while empty rooms sit there generating zero income. A self-storage facility looks from the outside like the ultimate passive real estate investment, just rows of metal doors sitting on a concrete slab.
From the inside, it's a hyper-local math game, where an owner's survival is quietly tied to local zoning laws, interest rate shifts, and the physical effort it takes for a tenant to move their boxes somewhere else. The metal building isn't really the business. The 5-mile radius around it is.